Greetings. This is a recording meant to assist CTA students or ITC students on borrowings, and it's really designed for your CTA studies, which is an ICAS-driven module. Right. My name is Gino Mapetere, and I'm head of the CAA Postgraduate and Professional Programs. So let's look at the taxation of borrowings. The taxation of borrowings, our learning outcomes there would be to identify and understand key transactions that happen when there is a lending, right? So we would need first to agree on what a lending is, and we would then have to work on the characteristics of that lending, things like what is the loan principal, what is the loan interest, just the key components of that transaction, and any loan repayment. Sometimes you are then, even in your examinations, given the use, what was the loan used for. And once we identify the transaction and its components, we then need to understand the income tax treatment of each of those transaction components. So as you can see, what is very important there as a candidate or as a student, or even in practice, is to first deconstruct your scenario or your transaction and say, what are the key components in this transaction? It really helps for you to then score the necessary marks in terms of completeness. In examinations, you find yourself getting that adrenaline rush and getting so excited about one or two elements that you've seen in the scenario, and you're thinking, good, I'm going to write this, that, and the other. I'm remembering the common law principle of this, or its interest, or it following the nature of the usage of the loan. And once you've written it, then you realize you're stuck, but you're looking for more marks. So you write something about 5 marks, and it was so exciting at the time of writing, but then now you realize probably after writing it that you still need to look for 10 more marks. And normally this becomes a problem to generate marks at that stage. So what needs to be done first, what needs to be done first is, what is my scenario? What is my transaction? What happened, right? What are the key things that happen when there is lending? Don't worry about the tax at that stage. So at lending, you know that the components are, there will be a principal. Someone will give another person an amount, and that's the loan principal. And then that loan, from the date of passing it on to that principal, to the borrower, interest begins to accrue on every amount or balance of the loan principal outstanding. For as long as there is passage of time, interest is accruing. So you need to really understand that it's some compensation for the credit facility, and you need to be compensated as long as the credit is still extended. So I know with math there's also the time value of money and other elements brought in, but here I just want to talk about the credit element, and interest is a compensation for that. And then the loan can be repaid in various ways, where the borrower begins to return it maybe in installments, or as a bullet point payment at the end, or both installments and one big or bigger than the rest installment at the end. Once you've understood in your scenario, or whether in practice or in an exam setup, once you've understood what you're dealing with in terms of what happened, you have to understand the timelines. Sorry, not once you have, but as you are trying to understand this, make sure you are understanding the timelines. When was the principal disbursed? Was it in one tranche? Was it in multiple tranches? So am I dealing with a loan which ultimately I will have to deal with separate components of the principal. When did this interest begin to accrue? What was the rate, the agreed rate? In accounting, you would then be even looking at what is the effective rate, and so what has been accounted for, which is very important for us for tax purposes, because ordinarily, especially for corporate tax, you will then be doing the tax computation departing from a point of what the accountant will have already done. So you need to appreciate how the accounting, if your IFRS or IAS has already dealt with this interest amount. And you need to understand this thoroughly first before you try to do any tax items. You need to keep the context of who the taxpayer is. More often than not, we see candidates discussing the loan principle in the hands of the lender when they are required to discuss it in the hands of the borrower. That has actually opposite effects in some cases, where with the lender, the loan interest will be income to them, to the borrower. That will be an expense. And so for tax purposes, the lender is looking at applying gross income principles, whilst the borrower is applying the general deduction principles. So it is a serious departure point that can drop you from a distinction to a zero, because you have misunderstood the context in terms of who the taxpayer is, but you could also have misunderstood in terms of what the timelines are. So for instance, if the loan, there was a loan borrowing maybe in 2020, and then the interest is accruing, the loan repayments are happening maybe up to 2025, and we're discussing tax treatment of this borrowing arrangement only for the year of assessment 2023. Your loan principal is no longer part of your solution, because that's something that happened in when the loan was borrowed. Did I say 2020 or something like that? So you're not too worried about that one. All right. So timeline can change your solution. And here, students, candidates need to be very careful, because you may have seen a question before on loan borrowings, and then now you're missing the point, because maybe in the first one, your principal was borrowed in the same year as in the same assessment year, in that assessment year of assessment, and therefore in your solution you're discussing both the principal, the interest, and if there are any initial repayments that are beginning to happen, part payments, you're discussing all three. But in some cases, the principal happened in an earlier year, the interest is accruing, so that one you can't avoid. You can't, regardless of how the interest repayments are structured, the interest accrues evenly across the period of the extension of credit on the outstanding amount. And therefore, the interest will accrue even if there is no repayment in that year. And maybe the other repayments are happening as a bullet payment at the end. So maybe in that particular year, there is no principal that was borrowed or lent out, and there's no repayment that is happening, but there is interest accruing. So that changes the scope of your solution. So candidates, you really need to be, for those that are writing an examination, you really need to be on your A game when you get into the exam. You cannot go in and regurgitate another solution for borrowings that you've seen before. Common pitfalls is what we're about to discuss here. So let's start with the lender. With the lender, borrowings do come about when someone is going to release an amount to another person, and for that, that amount is going to be returned, so it's already a borrowing. And this can happen in various forms. Call it different names. Sell and lease back. I don't know. There's so many ways in which an asset can be released. And then there's some repayment, but that then includes interest or compensation for that extension of credit. So your exams can come up with very different instruments. Usually when you look at most financial instruments, there is that borrowing element, because there's the financial liability that then accrues from a financial asset to the lender, in the hands of the lender, but then maybe it becomes a liability in the hands of the borrower. But point is, you have so many circumstances under which you are seeing borrowings in our day-to-day life. And so in your examinations, it may be like that. The word borrowings may not be used. The word lender may not be used. But the substance of the transaction is someone will have lent out some asset which is going to be repaid, and on top of it, there is compensation for that extension of credit. What are the key characteristics? You really need to understand the characteristics of interest, which is what I've just explained to you, because it then determines a lot of things. For example, it helps you judge where the source is. Remember, source is about why you are getting an amount and where that element of why you are getting an amount happened. So if you're going to understand interest as an extension of credit, as the reason why you are being compensated via interest, so the question you're going to be asking in source is, so where did the extension of credit happen? So that's what I mean by understand the key characteristics before you jump in to say, this is how you treat interest. You need to say, what is interest? Why am I being given this interest? I extended credit to someone. So where did it happen? So that's just an example of why you need to understand characteristic of a loan principal, the characteristics of the interest, and the characteristics of the loan repayment, because they will help you judge so many other downstream elements, such as the determination of the source. So interest, by the way, where credit happened, it's so complicated. It could be where credit happened could be taken as where the loan was then actually applied. So, or where they sat down and made the arrangement, or where the principal was then sent from. So this is why you need to understand characteristics of every transaction before you even go to the tax treatment. And then what is the principal and its income tax treatment? Let's talk about the principal to the lender. To the lender, what is he doing? He is releasing some value or an amount or money. So the question is, will they go and claim a deduction? And therefore, you're already trying to look at either the general deduction formula or anything specific under section 15, as read with any prohibitions in section 16. So as a student, the key thing there is to go and pick the most important element of section 15 and say, yes, a disbursement was made, but is it an expenditure? Or you want to discuss, look, this is capital in nature. Candidates can waste time by discussing capital in nature, purposes of trade. Clearly, when you are paying out an amount and you're going to get income from that arrangement via interest, it is for the purpose of trade. Or if purpose of trade is very difficult, because someone can say, no, that's not what it does on a day-to-day basis, and so on and so on. But remember, it is for the production of income, the income being the interest. So the question is that what you're supposed to be discussing? Or if this thing is capital in nature, there's no point in then explaining, but it's capital in nature, but however, it was going to be for purpose of trade or in production of income. So that judgment is what an applied examination will be focusing on. Your ability to pick out the most important point is going to be crucial. This is how sometimes candidates then lose marks. And then what is interest and its tax treatment as well. So I've just explained interest is what you are being compensated for the extension of credit. So therefore, you're looking at income, amount received. Again, there you have to make a judgment. In some cases, the amount is pretty straightforward. You're told how much the interest is. But sometimes maybe the interest is being paid via some barter transaction to say, you will make repayments and the interest component will be 30,000. However, give me that 30,000 by giving me one of your cars, which is maybe the client is a car dealer. So the amount then becomes an issue. The source can become an issue to say, where did I lend this money to? Maybe my client is in Botswana, and maybe I took the amount from a South African bank account of mine. So all those things can then, because of the context and the scenario, these judgments now need to be made. I'll also be discussing loan repayments. I'll be getting back my money if I'm if I'm the lender, and therefore, if at the point of disbursing they were capital in nature, therefore, what would the loan repayments be at the time of receiving? So common pitfalls, I've already touched on some of them. What principles do you want to test that will score marks for you in the exam? Which ones and how many? So once you pick on the wrong principles, although you are technically correct in explaining them, but if they are not earning you marks, they are wasting your time. Like I explained, if you're told how much the amount is on the interest, why waste time discussing that amount is corporeal, incorporeal, and so on? But if you're told that it's through a barter transaction, then amount becomes. So this thing about explaining something that is not necessarily relevant then creates your time waster, and it eats into your marks because you could have been using those 1.5 minutes per mark on things that actually score you marks. Okay, so judgment, context, those are them. You have to pick out what is the most important issue here. What is the signaling effect of the required in terms of the number of marks that are available for that question. The loan principal disbursed, is it an expenditure or loss? We've just discussed that. Should you be working on it from a capital in nature perspective or purposes of trade or intent, or do you want to discuss all of them? If you're going to be discussing some of them, be careful that you're really discussing something that makes sense. What this is really saying to you as candidates is try and apply yourself. It's also telling you as you prepare for an exam, do not gloss over without truly understanding what is at play, because you will not then develop that judgment, that skill, that ability to apply yourself to the scenario and context. Interest, like I said, I'm receiving interest, so what of those? Repayments, I've also done that. Some of the pitfalls are poor wording. Example, someone is discussing expenditure and they call it exempt. Or someone is looking at interest that is being received and then they try and call it prohibited instead of exempt, if it is exempt. And then conflating principles at application stage. So someone is discussing the interest income, and at some point, because you're discussing income, you begin to discuss purposes of trade. Whereas in terms of gross income, that is not a concept that you are too worried about. You should be worried about amount received, source, or capital in nature. So a once-off business, for example, that's probably what you want to say. No, they lended just once, and then I feel this, so it's capital in nature. Assuming that's what you wanted to say, then someone then explains that by saying this was not for the purpose of trade or in production of income, which is irrelevant when it comes to gross income principles. Let's look at the borrower. The borrower's context is that they received an amount. So that's the critical characteristics of the loan principle. So you have to apply gross income elements to the principal when it was received and conclude whether it is capital or not, so that you know whether it is gross income or not. The interesting one, obviously, is the interest, which there is a common law principle that we'll deal with. And then lastly, the loan repayments. Once the income was at receiving, once you characterize the entire principal amount as capital in nature, it then is compelling to also characterize the repayments as capital in nature. So let's quickly look at the common law principle on interest and legal costs. Here, what we're saying is, for you to know the nature of the interest, you need to know the nature of what the loan was used for. Students commonly say it the wrong way in the exam and don't get their marks for it. So the loan can be used for multiple uses, therefore the interest can have different treatment. And part of what the loan is used for can be such that the asset acquired could be ranking for capital allowances. And therefore, if the interest has also become capital in nature because this asset that was acquired was capital in nature, it means you capitalize the interest, and therefore the interest is deductible via capital allowances. However, there's a practical problem there that stems from understanding what interest is. If on day one, the interest is then said to be capital in nature because the asset that was acquired was capital in nature, the problem is how much? Remember, interest has not yet accrued at this stage. It has not yet been incurred even. Why? Because interest is incurred over the time which credit is extended. So you can't have the interest amount to expense on day one because the loan hasn't run. In other words, on day one, you borrow in the morning. If in the evening you go back and return that amount, there will be no interest. So you can't get, for tax purposes now, you cannot get a deduction for something that you have not yet incurred. So there's got to be a practical way that arises from the understanding of getting that deduction that arises from the character of interest. Because at year end, year of assessment, this loan arrangement could still have a loan balance outstanding. And that credit outstanding, the question is, so how will it be taxable? It cannot be through capital allowances, because remember, capital allowances are loaded onto the cost. It's about the cost on day one. So the practical expediency is, ordinarily, as the interest is accruing for accounting purposes, that's when it's deducted. Then thin capitalization is another key tax unique principle that arises out of this borrowing arrangement. Here, the candidate needs, or the practitioner needs, to understand avoidance. How a taxpayer can try and avoid paying their tax using interest. Now, ordinarily, shareholders would try and do that. That's one bracket of taxpayers who could do that, especially a foreign one, who then says, I have lended my business this amount, and therefore, may I have it back via interest. So what's the problem with that? The problem is, why is the owner preferring to inject capital into the business via borrowing? Why not call it capital and get a dividend from it? And the reason is because dividend and interest have different tax implications. Dividend from a company within Zimbabwe is exempt. In other words, the paying company and the receiving shareholder are not charged in tax on dividend. So to the paying company, they don't get an allowable deduction in their jurisdiction. To the receiving shareholder, they will receive the dividend and be taxed in their jurisdiction or interest. So it may well be that Zimbabwe may be having a higher tax rate, for instance. Therefore, it would be advantageous to pay this dividend as interest so that the company that made this profit will have a bigger taxable, will have will have a smaller taxable income because you will have upped your allowable deductions. I can repeat that. Where Zimbabwe has a high rate of tax, it is advantageous to up the allowable deductions, reduce the taxable income, and reduce the tax payable for the company that is paying out the interest. If you don't do that, you will have high interest, you will have low allowable deductions, high taxable income, dividends will not be allowable as a deduction, and that translates to high taxes. So, can you force a shareholder and say to them, especially a foreign one, whenever you are injecting capital into your business, do it via share capital? Clearly, the answer is no. So what we can do is we can look at the ratio of the shareholding versus the borrowings. Where the debt exceeds 3 times your shareholding, it then indicates that the shareholder is preferring to pump in capital via debt. And that could be deliberate avoidance because it is still legal to do that. However, as you know, tax avoidance has a tax risk. And the risk is once anti-avoidance mechanisms kick in, you will have that challenge of that interest, that tax which you thought you had saved or avoided coming back. And sometimes with punishable mechanisms. And that's what thin capitalization is about. It's an anti-avoidance. It then says, look, any debt that you are now pumping in that is excess to the 3:1 ratio, whenever you're going to pay interest on that excess debt, right, the interest that is allocable or that relates to that excess debt is now deemed not to be an interest payment to the shareholder, but a dividend payment to the shareholder. And that deemed dividend is punitive because dividend ordinarily, when it's paid, it's exempt. But now that dividend is excluded from exemption. So there's 2 things that are happening. The interest has been disallowed, you can't get a deduction, and the income, when it exits, going to the shareholder, it is then taxable as well. So that's quite punitive and very discouraging for shareholders to pump in capital via debt. Other common pitfalls are, as a candidate, what tax principles to test that will score you marks in the exam, and we've already discussed that. Your judgment and your context are most important. So for the principal, disbursed to you, is there an amount? Have I received anything? That's in the hands of the borrower. What about the interest? We've discussed the common law principle and so on. And poor wording normally is on the common law principle, where candidates then gloss over and say the interest follows the nature of the loan. That is incorrect, and I will put emphasis on that. The loan principle, yes, it has its nature. You will have determined the nature of the loan principle. But the interest doesn't follow the nature of the loan principle. It follows the nature of the usage of the loan principle. Other common challenges is conflating principles. Conflating means you're mixing them up. You discuss something as a section 16 thin capitalization matter. And in my case, in the example that I've just given you, remember there's also section 98. That slide should have said 98, not section 9. And there's a conflating of those principles. 98 is about arm's length. Yes, it's a foreigner, and there's that shareholder subsidiary or a relationship. And therefore, yes, there is a thin cap story. I mean, sorry, there's a section 98 transfer pricing story. But there's also a section 16 thin capital. In explaining these two things, you have to make sure that you're not conflating those principles. To say almost as if thin capitalization is about arm's length. In the end, as the student is mixing these, it becomes an incorrect principle. And also sometimes the candidate, in applying themselves, end up talking about purpose of trade or incurred, when that's not the key issue that you want to discuss. Or it is key, but you've stated the principle of thin cap, but as you're explaining it, you're now discussing incurred without realizing it. And now you don't score marks because maybe you've got a good principle, but you failed to apply it, and you're wondering, but there's a lot of keywords in your scenario that are also in the suggested solution, but somehow you feel they were not marking what, but it's in there, it's in my solution. It's because you're conflating principles. You've stated a principle, but the way you've explained the principle is actually incorrect. But in your explanation, you touched on another correct principle. So that's a common pitfall for students. And in the end, you just don't score good marks. Failure to calculate the deemed dividend is very important because now you're not quite clear on how to say, what is my excess debt, which will relate to the deemed dividend. I thank you. Let me know if you have any queries, especially if you're studying for an exam. Most of your students, of you as candidates, will have my number. If not, you can check with our client services and get my number and contact me for any further explanation. I thank you.